So most traders and investors find it frustrating that the market forces you to make a choice that you'd rather not make. Typically, slow-moving, boring, low-growth stocks are the ones that pay dividends so that you can get some income out of the longer-term stock investments that you're making. So you can make some income from your stock investment, but the prospects of the stock price itself growing are pretty dim. That results in a mediocre outcome in most cases. On the other hand, you may get excited about the growth prospects of a stock, but then in almost all cases, the exciting growth stocks don't pay dividends. So while you hope and wait for your stock investment to bloom, you're earning literally nothing on that portion of your assets tied up in the investment. But what if there was a way to invest in a high growth potential stock and at the same time make income while you wait for the stock to start appreciating in value like you believe it will? In other words, what if there was a way to invest in non-dividend paying stocks and essentially pay yourself a dividend while you wait for the investment to work out? If you find yourself intrigued by this idea and you'd like to learn a very simple way to achieve that exact goal, stick around and I'll teach you that technique right now. You'll be surprised how simple it is. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. You'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investment community. Now, in this video, we're going to be discussing a technique known as the covered call, and we'll be running through a powerful example of how it works to turn your growth stock into an income generating asset while you wait for it to blossom. I'll take you step by step through the process of implementing this simple strategy. And if you'd like to learn 3 real-world option strategies that our traders use, including the surprisingly simple and powerful strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window. And so don't worry, you won't lose this video. You can also visit optionsclass.com to register for this free intensive workshop. It's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so let's jump in. Everyone has heard of Amazon, and many of you may own the stock, in which case you're undoubtedly aware of the fact that Amazon does not pay a dividend. Amazon is also a very high-priced stock, having traded north of 1,000 for years now. To buy even 10 shares of Amazon would have cost you anywhere between $10,000 and $20,000 in the last few years. That's a lot of capital to have tied up in 10 shares of one stock that yields nothing. So I want to show you an example of how you could have effectively earned a dividend on Amazon stock while the stock price appreciates pretty dramatically using the covered call strategy. Okay, so how does a covered call work? Well, let's say you bought 100 shares of Amazon when it was trading at $5.50 a few years back. So you would have spent $55,000 doing that. Now, had the story stopped there, you would have invested $55,000 with no hope of any income over those shares while you own them. But what if you decided that you were going to engage in a covered call program to make income on those shares while you held them? How would that work? Well, as you probably know, a call on a stock entitles you to buy 100 shares of that stock at the strike price of the call option that you bought. But what many people don't realize is that you can be on the other side of that transaction. You can own the shares at one price and be the one who is actually selling the call to someone else, who in turn has the right to buy 100 shares from you at the strike price of the option you sold him. Now, the buyer of that call will pay you upfront money for that right. That's called an options premium. Now, if the stock never reaches the strike price of the call that you sold him, then you just get to pocket the call premium that he paid you originally. It works exactly like an insurance policy. The insurance company keeps the premium you pay, whether you have a claim or not. Similarly, if the stock price never gets to the strike price of the option, the call seller, you in this case, just keeps the premium and you don't have to sell your shares at all. So you just effectively paid yourself a dividend on that stock. You got income from the stock even though the stock itself doesn't pay a dividend. So now let's go on and see exactly how this works. So let's say we buy 100 shares at $5.50 and then move up an options chain which expires 30 days later to a price about 10% above the market. In this example, the market will pay you $1.82 for each share of Amazon that you own, or a total of $182 for your 100 shares, for the right to buy those shares at $6.10 if the market reaches that price by April 1. So the combination of the call that we sold at $6.10 and the 100 shares of Amazon that we own, that combination is called a covered call. If the shares get to $6.10 by April 1, then you've made $55 for each share of Amazon, so you've made $5,500, plus you've been paid an additional $182 for selling the call option. If, on the other hand, the stock never gets to $6.10, then you continue to hold the shares and you just pocket the $182 that you were paid for the call because the stock never reached $6.10. So the buyer of the call would just allow his call option to expire. Why? Well, he's certainly not going to buy shares of Amazon trading for less than $6.10 and pay $6.10 anyway for them. So he's just going to let the option expire, just like someone who buys a lottery ticket, throws it away because his ticket doesn't match the winning number. It has no value, so he tosses it, which means you get to keep your shares, plus you keep the $182 the call buyer paid you 23 days earlier. Okay, so in this first example, on April 1, Amazon closes at $5.98, and so the call option to buy the shares at $6.10 obviously is worthless, and you just walk away with the $182. But it doesn't end here. Instead, you simply do this every month. You find an options chain about 30 days out, you sell a call about 10% out of the money, and you either make 10% more on the stock and keep the call premium you were paid, or the stock doesn't appreciate 10% over that month, and you just, again, pocket the call premium without selling your shares. So let's see what happens in that next month. Remember, the stock was trading at $5.98 at this point, so the call about 30 days out and 10% above the market is now at $6.60 because the stock went up since we've owned it. For that call, we received $694. Well, that option, as it turns out, also expires worthless because the market closed below $6.60 on the day that the option expired. So again, we kept the premium we were paid, the $695, but we still have our Amazon shares. So to date, we collected $182 for the first month and $695 for the second month, for a total of $876 so far after 2 months. Now, if you did that every month, straight through to November of the next year, selling a call every 30 days, 10% above the market, then by the 20th straight month of doing this, you would have collected more than $5,200 of call premium and still had your Amazon shares. Now, over that period of time, the Amazon shares actually doubled to 1,100. So let's analyze your winnings on the final day of the program, which is in November of the next year, where the market finally catches up with your short call and you sold your shares for $1,100 after having sold 20 covered calls in a row during the 20 months of the covered call program. So during that period of time, here's the scorecard. We made a little less than $55,000 on the Amazon shares, plus we pocketed an additional $5,200 by selling the covered call each month. On our original $55,000 investment, that comes out to an annualized return of 5.7%. In other words, by employing the covered call strategy, you've effectively paid yourself a 5.7% dividend on a growth stock that doesn't pay a dividend at all. So to review, we made almost $55,000 on the shares and another $5,200 on the covered call income, for a total of over $60,000 during the 20-month period. In other words, we got a growth stock return with really solid income on top of that, a combination that just isn't available without options. Okay, so today we looked at the covered call, a very simple strategy that anyone can employ on shares that they own. We've seen how a program of selling calls against your owned shares each month can create what is effectively a dividend on shares that you own, even if the stock itself doesn't issue a dividend. So if you'd like to turn your portfolio of equity shares into a meaningful income producer for you, the covered call technique is something you're going to want to consider. And the exciting part of this is that the covered call is just one of literally hundreds of option strategies that you can employ once you learn the basic properties and fundamental strategies of options trading. Now, just to remind you, as I said earlier, if you would like to learn 3 more real-world option strategies that our traders use, including the surprisingly simple and powerful strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an options strategy that you can employ with a stock you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window. So don't worry, you won't lose this video. It's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, one more thing I'd like to ask you to do is to go ahead and click our subscribe button so you don't miss any of our trading videos produced for the trading and investment community. And while you're at it, please add your feedback in the comments section for what videos you'd like us to produce next, as well as what you found helpful from this video. So from all of us at SMB, trade well.